Hello participants, how are you? I hope you're all fine and in best of your health. So participants, let's start the day 2 of the financial management practice to pass sessions. First, let's say thanks to the ACCA for arranging such a good session for us, this webinar, and that also free of cost. So a lot of thanks to ACCA. And students, in the last session yesterday, we began with investing decisions, and a small portion of investment decisions was left yesterday. So first of all, we will complete that portion. A few questions left on investment decisions, and then we will continue with the working capital management, right? So in the last class, we were doing SC company, and we did the first part of it, which was calculate net present value. So we did this requirement A, and now we are moving on to the requirement B. So the requirement B is calculate the internal rate of return of the proposed investment in product P. So now what is internal rate of return? Let me define. Internal rate of return is the rate. It is the percentage at which the NPV of the project or the proposed investment is 0. The rate at which the NPV is 0. So we calculate this internal rate of return using trial and error method. So in order to calculate this IRR, we need to have two NPVs. One of the NPV should be positive and the other one should be negative if you want to obtain a closer answer, a better answer. So one of the percentages we have used was 12% to calculate the present value of the cash flows of the SC project, which was 9646, appearing on your screen, 9646. This has been calculated at 12%. Now we will be calculating one more. Yes, there is a handout for today as well, which is appearing on your control panel, right? Okay. So that's on working capital. Right now I'm using the same handout which we were using yesterday, right? Okay, so now we need to use another rate. If the NPV at the current rate is positive, then you will be using a higher rate. Like use a rate which is a bit higher than the current rate. 12, suppose this is 12%, use 20%. You can use a rule like NPV over here is 90,000 or 91,000. You divide this with the initial investment, which is 1 million. So approximately it is 9%, right? The NPV to investment is 9%. So you can take a rate which is 8 or 9% higher than the current rate which you have used. So once you increase the rate, the NPVs will reduce. The relationship between present value and the discount rate is inverse relationship. When you will increase the rate, the present values will decrease, and when the present values will decrease, your NPV will also decrease. So it is better to take a higher rate if you have currently a positive NPV. So let's take a 20% rate to calculate the second net present value, and then we will use both the net present values and the both rates, the lower one and the higher one, to calculate the internal rate of return. So let's calculate one more NPV for this proposal at 20%. So the steps that we'll be repeating again will be same as in the golden patch. So you will be seeing a golden patch over there in which you can see 4 items. One is net cash flow, the second one is discount factor, third one is present value, and the fourth one is NPV. So only this portion is relevant in calculating the second NPV of this project. So let's begin. So I'll be doing this portion again. I'll be using a discount factor now. At 20%. Earlier I used at 12%. Okay. So the cash flows, net cash flows will remain same. Okay, the discount fractions you can see from the table, or you can use 1 plus r to the power minus n. At 1 plus r over here will be 1.2 to the power minus n. So the discount fraction at year 2, at year 1 will be 0.833, and at year 2 it will be 0.694. At year 3 it is going to be 0.579, and at year 4 it is going to be 0.482. So these are the discount fractions at 20% rate. So now multiply the net cash flows with the discount fractions in order to arrive at the present value at 20% rate. So students, keep your calculators in hand and keep calculating. Multiply the net cash flows with the discount fraction at 20%. So the NPV now at the 20% rate, the higher rate, is negative 92,571. Yes, participants, I will be sharing these Excel sheets with you. So you will be having the answers of all these handouts with you people. Okay. Yes, you can, but over there in the exam, you won't be having the IRR formula, right? So you have to use this one, right? You won't be having all the the formulas in the Excel format which you have, right? Hmm. So you have to show the working in the exam. Okay. No, no. Okay. So students, please go through the exam platform. If I get time, I'll show you the exam platform as well in this webinar. So we'll discuss for a few minutes and see what's the format of the exam platform. You would have seen it in the previous exams, like if you have given F5 in performance management and the tax exam or the financial reporting exam. But if we get time, we will discuss it, right? Okay, so let's use the internal rate of return formula to solve this out. So the internal return formula is IRR is equal to the lower rate L stands for the lower rate multiplied by NPV at the lower rate. NPVL is NPV at the lower rate, okay, divided by NPV at the lower rate minus NPV at the higher rate. Divide by this and then multiply by the higher rate minus the lower rate. So that's the formula for the internal rate of return. Let me simplify a bit for you so that you can calculate it properly in the calculator. Okay, if you put figures in this formula, the lower rate is 12% plus the NPV at lower rate was 90,646 divided by 90,646 minus into minus will become 92,571 because the NPV is negative. So it will become a plus and then we'll multiply it by 20 minus 12. So this gives you an IRR which is approximately 16%. So IRR of this project is 16%. So in the yellow patch, you can see the working of internal rate of return. Yes, I will be discussing question 4 as well at an appropriate time today. Yes, I've shared the recording of session 1 in the group today. Okay, so it's approximately 16%. It is around 15.9 something. So this is the internal rate of return. Okay, students, only those functions you will be able to use which are available on your exam platform, right? So you won't be able to use formulas which are normally available on the Excel sheet because the worksheet that's available on your exam sheet is only allowing you a limited number of functions over there, right? Okay, so student, let's move on to the next part of this question, which are some theoretical and descriptive answers. Let's solve them. Okay, so the next part is advice on the acceptability of the proposed investment in product P and discuss the limitations of evaluations you have carried out. So participants, let's discuss whether this proposal is acceptable or not and then discuss on the limitations of our evaluation being carried out. So let's start with requirement C. Okay, so students, along with writing the answer, I'm discussing the evaluation part along with the limitations of our evaluation. So the first point is that the NPV of the proposed investment is positive. Hence, the project is expected to increase the wealth of the S company. Therefore, it is worth accepting. Right? So if the NPV of the proposal is positive, only then you would accept the proposal. Okay, so over here, when you're writing the answer on evaluating the project, remember one thing, that first of all, write that on what method you are evaluating. So it was NPV on the basis of which we were evaluating this project, and then write the rule that if it is positive, then you are going to accept it. Okay, and another method also we have used over here. We have used two methods in this question in part A and B. So another one was internal rate of return. Then internal rate of return of the proposed investment is 16% approximately, and is higher than the cost of capital. Therefore, the proposed investment is financially viable. Okay, so over here the rule is that in order for a project to be acceptable, your cost of capital should be less than the internal rate of return. So your cost of capital is 12%, which is lower than the internal rate of return. Therefore, the project is acceptable. So the conclusion is that both the NPV and IRR methods indicate that the proposed investment is acceptable. Okay, now this was the evaluation, the first part of our answer. Okay, now there is a question attached to this one, and that's limitations of evaluation. Now, what do we mean by limitations of evaluation? So by limitation of evaluation, we mean that that the information is either short, and on the basis of short information or limited information, we are not being able to completely evaluate the proposed investment, and we need that information. Or by limitation, we mean that we need a better technique or a better formula, so that we can uh, use that formula, the better formula, and can properly uh, evaluate whether to, and properly decide whether the investment is acceptable or not. So either by limitation, what do we mean by limitation? That there is some shortage, there is a limit on either the information or the methods being available likewise. So there is some shortage, so find that shortage out of the question. So the answer will be based on the scenario which is given to you in the exam paper. So we cannot write on the limitations by learning from home. We have to basically consider the question, read it, and we'll find the answer over there only. Over here in this question, there are some limitations which you can mention, and one of them is see the forecast sales volumes. The sales volumes being given over here, do you believe that you can know them accurately when the product's life cycle is short? So it is very difficult to estimate uh, sales volume, the sales quantities. So if the sales quantities are not predictable and the products, when the product life cycle is short, so obviously it will be difficult to exactly comment on the NPVs, because your NPVs can be different, right? So if you want to improve your answer, it's not enough that you give limitations. You can also mention some solutions to to those limitations when you mention them. Like in this case, if you have a sales volume which is exactly not certain, and it can be different from that which we have considered in this question, so we can use sensitivity analysis, or we can use what if analysis, that if the conditions change in the future and the sales volume change, what happens to the net present value, what will be the revised net present value, won't it get negative? So this is how we can evaluate in presence of a limitation. So we need further information regarding the sales volume in different conditions which can happen in the future. So let's write this out. It's not only the one variable, sales volume. Apart from the sales volume, there are other variables as well about which we need information. So one of them is the inflation rates, which we have judged to be 4% and 5%. So these inflation rates, will they remain same throughout the 4 years time? Usually the economic conditions change over the years, right? So if the economic conditions are changing over the years, the inflation rates will also change. But we have assumed that inflation rates on the variable cost and the sales prices and the working capital requirements will remain same over the 4 years time. So that's not, again, a practical thing. We should know that if the inflation rates change due to change in economic conditions, what happens then? So again, the solution to this problem will be the sensitivity analysis. We will see that if the inflation rate change, what will be the effect on the net present value? Is the NPV sensitive to changes in inflation rate, and can it be so extreme that the NPV gets negative on a big change or a small change in the inflation? If only due to the big change in inflation or increase in inflation the NPV is affected, only then the project is risky. But usually small changes occur, there won't be a big change, right? Because we would have done some research before the project starts. So if there is a small chance of a change, if there is a very if there's a very if there's a chance that a small change will make the NPV negative, then the project gets risky. So we have to be careful in that case. So that indicates us in advance. So sensitivity analysis is basically uh, an indication to us in advance. Okay. Another thing which is which can be highlighted over here, which we'll write afterwards. Let me write first about the sales volume and the inflation rate. Okay. So the forecast sales volume the forecast sales volume that have been used may be different in reality once the project begins, and it is difficult to assess it for a product having a short life cycle. So in this case, the company may use sensitivity analysis in order to know that whether in various conditions, can the NPV be negative, or the project may be loss making? Okay, so this was about the sales volume. Let's consider some more items. The inflation rates are estimated and assumed to be same during the 4 years of the project. So as the inflation rates may not remain same for the 4-year time, the company shall consider undertaking a sensitivity analysis in order to know what different inflation rates can be in changing conditions or in different conditions, and what can be its effect on the NPV of the project, which is right now positive, but due to change in inflation rates, the NPVs may change. So we can study the impact of it. Further, we can also write on the fixed cost. They have assumed that the fixed cost is not changing as they have spare capacity. But if you see in the year 3, in year 3, you will note that you can see in the year 3 that the production volume is 75,000 production and sales, compared to the year 1 in which it is 35,000. So production is getting doubled. So you may not have spare capacity in the year 3. So at that time the fixed cost may increase. So they have not considered this point. They may not have considered. So they need to consider this as well. No, we won't calculate until they will ask us to calculate, right? So if they ask you to calculate a sensitivity, okay, how much is the sensitivity, what percentage will change the NPV, only then we will calculate it, right? So please don't calculate. They just want to know the limitations. They don't want you to calculate it, right? Okay. So one more point we write over here. The question, the company also assumes that it has spare capacity and the fixed cost But in year 3, we see that production has almost doubled. Than in year 1, and the company may have to consider the effect of more capacity requirements. So students, a very important tip over here is that when you solve these type of questions and you're asked to write comments on it, the answer is always present in the question. You have to find the answer from the question only, right? Like over here, the estimates were involved. The sales volume was also estimate. The fixed cost was also estimate. The discount rate is also estimate. The inflation rate is also estimate. So we need to know that the estimate may change in future. So this was a big limitation of our evaluation in this case. So the methods being used were good enough, the NPV and the IRR, but the information and the data we were using were not accurate enough, basically, on which we have commented over here, right? So this was the answer. And secondly, always write the basics, because this paper F9 is a basic of financial management. So do not avoid writing that NPV is positive, therefore the proposal should be accepted. If you don't write this, you lose an easy mark. You have to write this out in order to gain an easy mark, and then go on into the depth and say tell about the limitation. Also tell about the IRRs, the rules which are used, and then comment on it according to the question. But keep the scenario linked and keep matching the scenario with your answer. It's not, please do not answer on isolated basis, that you ignore the scenario and just write your comments which you have learned from the book. Try to link the answer with the scenario. You will get easy marks from it, right? So secondly, examiner do have a script on which they have an expected answer, but if your answer is correct, justifiable, and it is different from the examiner script, examiner is intelligent enough and he will be giving you, awarding you a mark, even if they don't have that answer on the script, because it is logical. So please do not hesitate in writing one of the things in this section C question, because you are not negatively marked for any or penalized for anything in writing over here. So always do write whatever is sensible in a particular situation and you feel that this is correct, so go for it. But first think, okay, your knowledge and the things being read from the past exam questions and the exam kits and the books supports your answer. But suppose you do not remember or you have not learned it, do not hesitate in writing. Please go for the answer and write something relevant from the scenario, and find things in the scenario which helps you answer your question, so you can get easy marks from there. So that was an important tip regarding this question. Okay, students, I'm going to share the Crockett question which I gave you the assignment in the last class. But before that, let me do this part D as well first. The part D asks you discuss how net present value method of investment appraisal contributes towards the objective of maximizing wealth of the shareholders. So students, before writing the answer, you can make a short, students, please note that look at the time and the marks on which you should base the answer. Yes, one more thing. The a student asked me that if I write just on inflation, that if we assume they have assumed it to be constant, won't we get mark? No, it's not like that. The marks varies according to the depth of your answer and the quality of your answer, right? If you write that the inflation is constant and the fixed cost has been kept constant, assuming that the spare capacity is there, you will get marks obviously out of it. But the answer quality only has improved due to giving the solution as well along with the limitation. So if you write the solution regarding all the three items in the end also together, that sensitivity analysis can be used to consider the limitation which has been mentioned above, only then also you will get marks. So don't worry, whatever you know and the depth you know, please write it down, right? So the more uh, is the quality of your answer. Don't go for the length of your answer. Length of your answer is not that important. The most important thing is that you are complete and there is a good quality answer in it. Be concise. Okay, I'll be moving the sheet once more so that people who have not noted it can do it. I'm moving, scrolling it towards the answer. So please, I'm giving you a 2-minute time to note it down. Until then, the participants who have already written it, find a link between NPV and the wealth maximization of the shareholders. So I'm going to next discuss the link between the NPV and the wealth of shareholders. Okay, what I do is I put a minus before the number and then I go on to this comma on the control panel of the Word, this Excel sheet. So I get a bracket over there on the outflow. Yes, I'll be sharing the solution after I do this part D. Okay, students, let me tell you the link between the NPV and the wealth of the shareholders. So what happens that primarily the profit seeking companies seek to maximize their shareholders' wealth through either increases in share prices, means capital gains, or through dividends. Now, both of the dividends and share prices will increase if the company enters into some proposals that have positive NPVs. The positive NPV projects increase the wealth and the profits and wealth of the business. Remember that NPV is calculated using present value, which discounts the cash flows using the shareholders required rate of return. This means that positive NPV will arise only when the return on the proposed investment will exceed the return expected by the investors, by the shareholders, right? So the first thing is that if the company's wealth is increasing due to increase in NPV, obviously the share price of the company will increase as the assets will increase. And secondly, the dividends also depend on the profits. So NPV positive means that the company will be earning profits in future. So by selecting projects with positive NPVs, the future profits and dividends and the share price increases will happen. So the wealth of the shareholders increase in this way, their assets will increase. The shareholders' assets will increase. And the supporting argument is that when calculating NPV, we discount the cash flows with a expected rate of return with the shareholders expect. So if the shareholders expect 12% from the entity, we first calculate the present value. Due to calculating present value, the present value is gets lower than the cash flows. So already the return to be paid to the investor have been deducted from those cash. Increases the excess of 12% and is payable to the shareholders, right? So this is how the wealth increases due to net present value. So we can even say that, okay, I'm giving you a few minutes to copy this out. So please take a 2-minute time to note it. Then I'll be moving on to the Crockett questions answer. So you can take some snapshots of it. So students, you can write something further also on it, that sometimes the management, knowing that they want to increase the shareholders' wealth, they have their own short-term objectives as well. Like they want a good remuneration earlier, but using a new project to which a positive NPV is attached, the NPV will flow in the future, maybe around in 4 to 5 years, that NPV will be earned. But the managers may need remuneration earlier. So they may go for those projects which have lower NPV, but which can give them a better remuneration in the current year. So sometimes they may not go for better NPV projects right now to increase the shareholders' wealth, as their objectives conflict. So you can write one more line over here, that sometimes the management objectives may conflict, like early remuneration of managers. Okay, so it may show a conflict, and sometimes this also happens, that managers may go for a negative NPV project in the short term for 4 or 5 years to gain a good market share. But that negative share, that negative NPV may reduce the wealth in the near future, but in the longer term, it may uh, snatch a good market share in the 4 to 5 years, and then after 5 years, it may gain a good NPV project, a good NPV project, which may increase the shares price very rapidly. So the share prices in the short term may go down. So this may also happen. So look, students, what I want to teach you over here, that there is an obvious answer to every question. But if you extend a bit and write one more line extra regarding something which you can write over there, and it can increase the quality, then you can impress the examiner and get some extra marks from it. But Students, am I audible now? Can you see me now? Okay, okay, thank you for responding. Thank you very much. So let's continue. I'm showing you the answer to the Crockett question which I gave you as assignment yesterday. You can take a snapshot of it. I'll keep scrolling it down for you to take snaps. I will share it in the group as well. So that's the NPV calculation for project B. First, we had to calculate the NPV of project B, which was not given in the table. Then the calculation of profitability index, NPV per initial investment amount, and the ranking. And then the best combination of the projects that shall be selected to arrive at the highest NPV that can be earned, the optimal combination. Yes, I'll be sharing it over there. Okay, okay, I'll slow down. I'll scroll it again. Don't worry. Then part B. This was regarding the equivalent annual cost method, which we discussed in the previous class. Then requirement C. This also we discussed in the previous class, the nominal rate approach and the real rate approach. Money cash flows to be discounted by money rate and real cash flows by real rate. Real cash flows do not involve inflation. Real rate also do not involve inflation, but money cash flow and money rate do. Okay, student, I'm going to scroll it once again for people who have missed any portions. This is answer to the question which I gave you as an assignment yesterday. Crockett company. This was asked in the previous 2 attempts, either in September or in December. Yeah, if all of your funds are invested and then you are not left with any funds, then obviously we have to ignore those projects even with positive NPVs, because you don't have any funds to invest in it, right? So first you have to go and invest in projects with the rank 1, right? So that the you can maximize your NPVs, you can earn the highest possible NPVs. So in the end, when some projects left behind, they will have NPVs which are positive but lowered NPVs, so you can safely ignore it because you have earned the better ones, you have earned from the better ones, right? Idrissa, it is okay? Okay, I'm moving forward, scrolling it down. Okay, I hope now you people would have been able to capture it properly. Okay, so students, now I'm moving on to question ASOP. So the next question is question number 7, and that's ASOP. Question 6 is also on capital rationing. So I'll be providing a short discussion on it after we do ASOP. ASOP is a question on lease or buy decisions. So students, please go through the question. Please read the question. I am giving you around 5 minutes to read it. Then I'll be starting this question. I'll first explain how do we solve the lease or buy question, and then I will solve it. Okay, students, the requirement of this question, the first requirement, this is an important requirement. Remember, students, the tendency of examiner asking for capital rationing and asset replacement and lease or buy decision has increased in nowadays. So please do these properly. So based on the financing cash flows only, calculate and determine whether ASOP company should lease or buy the new technology. So the question is, you have to decide whether to obtain this equipment on lease or to buy it. Now see what we have to do. We have to calculate two NPVs. One NPV in case we lease the asset, right? And second, in case we lease, we buy that asset. Buy means we borrow first and then buy the asset. So how should we obtain the asset? This is a financing decision question as well, that whether we should obtain a loan and then buy the asset, or we should obtain a lease. So along with this investment decision, we are covering the financing decision question as well over here. So this is also part of the day 3 work as well, right? So we are doing a bit of day 3 work today uh, in this section, which is as it is linked to the investment decision part, right? So now what happens, that if you remember these basics first, that if you borrow and buy that 1 million asset, what happens, that you will be paying 1 million immediately. So you will be having a 1 million outflow immediately. But if you lease it, in case of lease, what the question says, that you have to make the payment of 380,000 every year in advance at the beginning of the year. So you won't be paying the whole 1 million, you will be paying just 380,000 in 4 tranches. Then the second point is that once you buy the asset, you get the ownership. The tax depreciation or the capital allowance is only available when you own an asset. So if you buy the asset, you will be able to obtain the tax depreciation. So you will save some tax money. In case of lease, what happens, that you do not get the title. The title to the asset or the ownership of the asset always remain with the lessor. So you won't be able to claim the tax depreciation or the capital allowance. But instead of that, you know that all businesses have a taxable income and you deduct rent from it. So lease payments are just like rentals. So this 380,000 will be deductible from your taxable income. And ultimately, if you deduct 380,000 from your taxable income drops and you save some tax money in case of lease as well. So what's the difference between the two? In case of borrowing, you can claim and deduct tax depreciation or capital allowance from a taxable income and save tax. And over here, in case of lease, you can deduct the rent or the lease payments and your taxable income decrease and you save tax. But the timing will be different. So due to the change in the timing of cash flows and amount of cash flows at different timings, the present values will differ. So that's what important over here. So one of the item is the payment of the purchase cost and the rentals. The second one is the tax depreciation and the tax saved on rentals. The third one is that once you buy the asset, you will have to obtain a license yourself, and you have to make the license payment per annum of 108,000, 104,000, which will increase by 4% from second year onwards. 5%, sorry. So there will be an inflation effect on the license payment. Now, the license payment are also a business expense, so you can deduct the license cost also from your taxable income and save some taxes. So in case of buying the asset, you will be able to deduct uh, the license fee as well from your taxable income and save some taxes. But in case of leases, you won't be paying any license fee, because the license fee will be paid by the lessor, because license will be in the name of lessor. So he will be paying the license fee. So you won't be having a cash flow in your NPV calculation, right? So these are the basics, basic cash flows which we'll be using in the NPV calculation. And the NPV over here will be negative, because the items which we are taking involve more of the outflows and less of the inflows, which are just tax savings, right? So first, let me make the cash flow, and then we will calculate the net present value of the buying on and leasing option. Let me first do the buying option. If ASOP buys the new technology, Okay, so let's make a pro forma. So first cash flow will be the capital expenditure, which will occur on year 0 and which is 1 million. Then ASOP will have to pay the license fee, and the license fee in the year 1, what they say that the license fee 104,000 is payable by the end of year 1. So I'm taking it at year 1. Year 1 means 12th month, and then the license fee will increase by 4% as per question. So let me show you the key points. The cost of the asset is 1 million, scrap value is 100,000, license fee is 104,000, and it will increase by 4%, and the first 104,000 is payable at the end of first year. So from second year the prices of license will increase. Right, then one time more increase the license fee by 4%, multiply 108 160 by 1.04, and then one more time increase by 1.04. So 112 486 multiplied by 1.04. This gives you the fourth payment. So I've increased the license fee by 4% from the second year onwards. Okay, so students don't worry about the group. You will be able to join it. It's not a that difficult job. Please right now concentrate on this on these workings. Okay, now after payment of the license fee you will calculate tax benefits. Now tax benefits are of two types in this case. One tax benefit is that uh, you will be able to deduct the license fee every year from your taxable income and save some taxes, right? And secondly, you will get capital allowance. So let me first do the working for the capital allowance, which is tax depreciation. And according to the question, the question says that, let me highlight it for you. The last paragraph says that if the company buys the new technology, it can claim tax allowable depreciation on the investment on a 25% reducing balance basis. So on reducing balance basis, you will get the tax benefits. Okay. So let me make a WDV column first, written down value column, and then the tax saving at 30%. So on year 0, the purchase cost of the asset is 1 million, and then the capital allowance on this will be 25%, which is 250,000. This is for year 1. Then if you deduct 250,000 from it, you are left with 750,000. And the next capital allowance, the second one, in the second year will be 750,000 multiplied by 25%. Now when you deduct this, you arrive at 750,000 minus 187,500. The third capital allowance will be 562,500 multiplied by 25%. And then the book value remaining is 140,625. Now, in the end, in the fourth year, last year of the project will not attract a capital allowance. You will have to calculate a gain or loss on disposal. So in the last year, the asset has been disposed of at 1 lakh. So if it has been disposed of at 1 lakh, you will incur a loss on disposal. So if you incur a loss, this loss can be deducted from your taxable income and will reduce your taxable income and will save some tax money at 30%. So the loss amount is 321,875. Now what will you do? That calculate 30% of these amounts. 250,000 will be deducted from your first year income, 187,500 from second year income, third year 146,25 will be deducted, and 100,000 will be deducted from the fourth year income. Now when you deduct these, not 100,000, it is 250,000, 187,500, 146,25, and then 321,875, which is the loss. Now you will put a 30% rate on these and you will arrive at the tax saving. So why 30% rate? Because your income will reduce by 250%, but the tax rate is 30%, so you will save 30% on it. So let's calculate 30% on it. So please take your calculators in your hand. So these are the tax saving on capital allowances. Then you will also save some money on licenses. Tax saving on license. So the next is tax saving on license. Okay, so the tax saving on license fee is the license fee multiplied by 30%. If anyone has missed it, you will be able to get a video of it afterwards. You can look at it and listen to it afterwards. No, if you have leased it, the question is clear. You don't have to pay the license fee. The loss is not 100,000. The sale proceeds is 100,000. It is a, so if I deduct the sale proceeds 100,000 from the book value, I will get a loss of 321,000, right? Sale amount is given in the first paragraph. First paragraph, they've told you that they will buy at 1 million and then they will sell it after 4 years at 100,000, right? 8.6 is the borrowing cost, is the interest rate. 421,875 is the book value, Vivek, out of which if you deduct 100,000 resale value, you will arrive at a loss. Okay. It's 421,875. It's correctly done. Okay. So students, on the license fee, you can deduct the license fee from the taxable income. So take 30% of the license fee also, which you will be saving as tax on your taxable income. So what I'm doing now, I am multiplying the license fee. The first year's license fee was 104,000. I'm multiplying it with 30%. So you people to multiply it with 30%, the license fees. 108,160 in the second year multiplied by 30% saving. Then in the third year, the license fee was 112,486. So multiply that 112,486 with 30% to arrive at the saving. And in the fourth year, the license fee were 116,986 multiplied by 0.3. So the license fee savings have been calculated now. Okay, so the total savings, tax savings, add these two items for the total of the tax savings, 75,000 plus 31,200, then 56,250 plus 32,448. Okay, Vivek, you were talking about this. The tax savings is 42,188, right? You are right. Actually, sometimes in speed, these clerical errors occur. I'm really sorry for it. To maintain the speed as well. Okay, so tax benefits will be now taken to the main pro forma. So I'm taking the tax benefits, the total of the tax benefits to the working above. So these will be taken as positive because this is a saving and you will save some cash. So students, an important point over here is that when the tax will be paid, one more important point to be considered over here is when the tax will be paid. So if you note that in the question, what they say, let me highlight that the company, let me highlight by blue, the company pays taxation 1 year in arrears. What do we mean? At an annual rate of 30%. This means that if the profit is earned in the first year, the taxable income arises in the year 1, but the tax will be paid in arrears, means in the second year the tax will be paid, right? So that's why the project is for 4 years, but the years which I have made in the question in the pro forma is 5. The reason behind is that the first year tax will be paid in the second year. So the tax saving will occur in the second year. And then the second year's tax payment will occur in the third year. So 88,698 saving will occur in the third year. This is related to second year, but as the taxes are payable in the arrears, therefore they are occurring 1 year later. And then the fourth year tax saving in the fifth year. So there we get the tax savings. Okay, after calculating the tax benefits, calculate the net cash flow for borrowings. You'll have to add the cash flows for 5 years. So there you get the net cash flows of borrowings. Now, in the next step, you will use a discount rate, the present value fraction. Now, what present value fraction will be used? So remember that they have given you borrowing cost. In the question, they have given you borrowing cost. Borrowing cost means the cost of obtaining the loans. Now, what happens that let me highlight first the rate. It is 8.6 given in the question. So if they have given you a borrowing rate in the question for lease or buy decision, you are going to use the borrowing rate for both the leasing option and the borrowing option as well, so that like versus like comparison occurs. So look, in this paragraph, I'm circling in blue. They have given you loan paying interest at an annual before tax rate of 8.6%. Now, we won't use before tax rate. We will always use an after tax rate. Always use an after tax rate, not a before tax rate. 8.6 is before tax and the tax rate is 30%. So what happens? There is a tax shield. Tax shield means that if you incur an interest cost and you obtain a loan, you incur an interest cost, interest can be deducted from the taxable income. And when you deduct it from your taxable income, you save some taxes. So you will save 30% of this 8.6%. So what will be the net cost? The net cost of yours will be 6%. So what's the formula for this? Borrowing cost should be net of tax. So they've given you the borrowing cost 8.6%, which is before tax. So what you have to do, you have to take borrowing cost net of tax. The formula is the interest rate multiplied by 1 minus tax rate. 1 minus t is the tax rate. So 8.6 multiplied by 1 minus 0.3. 0.3 stands for the tax rate 30%, right? So this makes 6%. So the discount rate for this question that will be used is 6%. So please, I'm highlighting this area, the borrowing cost area, which you can see in light maroon. So 8.6 was the before tax borrowing rate, and we'll be using the after tax borrowing rate. So present value fraction that will be taken over here will be 6%. So first year, in the year 0, 1 million is present value itself, because what do we mean by present value? That if cash flow occurs on the decision making date, what will be the cash flow? It will be full 1 million. But if the cash flow is delayed, only then you have to take the present value. So at 6%, the present value fraction will be 0.943, 1.06 to the power minus 1. So please calculate or use the tables. For the present value fraction up to 3 decimal places. The second year will be 0.890. The third year will be 0.840. Fourth year will be 0.792. And the fifth year will be 0.747. So these are the present value fractions at which you get the present value. Multiply the net cash flow with the present value fraction to arrive at the net present value. Okay, now add all these present value to arrive at the net present value. One more cash flow remains, and that's the resale value. So in the capital expenditure column, note one thing, that we purchased the asset for 1 million, and now when the 4 years are over and you own the asset, so if you own the asset and it's your own asset, you can sell that asset for 100,000. So you will resell at 100,000, and the cash flow in the year 4 will be a positive 158,948 multiplied by 0.792 gives you 46,686. So now add all these cash flows, the present value of cash flows, to arrive at the net present value. So the net present value is calculated to be 974,763. This is net present value of buying option. Okay, now let's move on to the leasing option. So I'm giving you 2 minutes time to note it down. So please complete it first. Then I'll move on to the leasing option. Leasing option is a shorter one. I'll be using the NUTs to solve the leasing method, because 380,000 will be the payments for the 4 years time in advance. So it's an NUT, equal cash flows at equal intervals of time. So I can use an NUT over there, and the tax saving will also be equal, 380,000 multiplied by 30%. So I can use an NUT over there. So I'll be using NUT, but a technique is required over there. Timing is very important in calculating the present values. Okay, first please complete this. Okay, students, remember one thing. There is a question. Yes, there are two questions over here, important ones. That the question doesn't mention anything about tax savings on license costs. Remember, all business expenses like maintenance cost, like licensing cost, running cost of assets, these are business expenses. They should be deductible from taxable income. That's why I have deducted it from taxable income. Rent is also deductible for tax purposes, right? Okay, then there is another question. What will happen to the production volumes that are given? See, right now we are not calculating NPV of the project. In the next part, they are asking for the NPV of the project. When you are calculating NPV of the project, whether to run the project or not, whether to select the project or not, at that time you will include sales and variable costs and those items. But when you are calculating lease or buy decision, you won't consider sales, because sales will be equal in both, whether you obtain the asset on lease or not. In both cases sales will be same. So we only consider differential cash flows, which are different in both options. Those cash flows which are equal in all the options, we don't consider that, right? So that's why I have ignored the production cost and the sales and all those items which are similar in both. So I will only consider those items which are different in leasing option and the buying in option. Okay, Omar, uh, it's okay now. Yes, Akasha, I have included the scrap value in the fourth year. 11% is the cost of capital. Cost of capital is used when you calculate the NPV of the project, whether to start the project or not. So initially, first we see whether the project is acceptable or not. Once the project is acceptable, Temur, then we go for whether to lease it or buy it in the second place. So this is what happening in the second place. We must have assumed that the project's NPV is positive. That's why we are going on for the lease or buy decision, right? No, Idrisa, in the first place, as I said, we will check that we should select the project or not. At that time, we will consider sales and all like we did in past, right? Once this is done, then we will think that how to buy the machinery. So we are in the second step right now, that how to buy the machinery. So in this case, we don't need to consider the sales, because sales will be same in both option, whether we lease it or buy it. So we have already considered it in the first step by calculating the NPVs, and if the NPVs project, only then we move on to the next step, which is this one. Yes, they haven't said you about license fee tax saving, but in case of buying, you have to pay the license fee. But in case of leasing, you don't have to pay license fee, right? So over there, they are not going to consider license fee. It is different over there, and over in buying, you have to consider the license fee. So it's different. That's why we have considered. So we have going on only to consider the differential cash flows. That's why we need to consider it. Okay. The operating cost is never a finance cost. Operating cost includes the production cost, the marketing, the administration cost. It never includes finance cost. Finance cost is basically the interest, right? Okay, so let's move on. I've given answers to your questions. So now leasing option. If ASOP leases the new technology, what happens then? Okay, so students, if they lease the technology, I'm using the present value technique of annuities. You remember annuities? You will be using the annuity table in this case. Annuity is the annuity table gives you the present value of all the payments together. If you have a 5-year payment, so if you add all the present value fraction from year 1, year 2, year 3, year 4, year 5, the total appears in the annuity table. AF stands for annuity fraction. Okay, so over here, in case of leasing, what they say that the first payment of 380,000 will occur immediately in advance, means on year 0. Then after 12 months, year 1, year 2, and year 3. So at the beginning of year 4 means end of year 3. It's same thing. So from year 0 till 3, the payments will occur for 380,000. And as this is an outflow, we'll be taking it in minus. Okay, now suppose the year 1 is going on. Year 1 is going, and on the very first day, which is taken year 0 over here, right, for 380,000 payment, you make a rent payment. So this will be taken for tax purposes in year 1, isn't it? You will be deducting this 380,000 from taxable income of year 1, right? So if you deduct from taxable income of year 1, the tax saving will occur in year 2, isn't it? So the first tax saving will occur in year 2, then in year 3, then in year 4, and then year 5. So the tax savings are going to occur from year 2 till year 5. Let me repeat again. The tax saving amount is 380,000 multiplied by 30%. So if you pay 380,000, the rentals to the tax to the leasing company, 380,000 will be deductible from the taxable income, and your taxable income reduced by 380,000 in the year 1, as you have made the payment of 380,000 in year 1, and you will be saving 114,000, and the saving occurs in the year 2, because if you deduct it from year 1's taxable income, the payments are in arrears, so you will be saving in year 2. So the tax saving amount will be 114,000, which is taken as positive. Now, what about the annuity fractions? We need two annuity fractions. AF when n equals to 3. Or we should say annuity fraction in case of rentals when n equals to from year 0 till 3. Now, how will we do this? In the annuity table, they give you annuity fraction starting from year 1. Means from year 1, year 2, year 3, these 3 fractions are added in the annuity fraction, right? So in order to find out this, first we need annuity fraction when n equals to 0. When n equals to 0, the annuity fraction will be 1. And then we will take annuity fraction when n is equal to 3. So you need to pick annuity fraction when n equals to 3. The first payment is immediately. So the present value of the first payment will be 1. So now look at the 6% rate and either place in your annuity formula 1 minus 1 plus r to the power minus n divided by r, or find out from your table. So the present value fraction is 2.6 3.673. Add these two, the present value fraction of the first payment, which is in year 0, and then the 3 years amount. This gives you, this will be placed for calculating present value of rentals, 3.673. And then another annuity fraction we need, which is from n equals to 2 till n equals to 5. Now, how will we calculate this one? Again, annuity fraction starts from year 1, 1, 2, 3, 4, 5, but we don't need year 1. We just need year 2, 3, 4, and 5 annuity fraction. So first we will pick annuity fraction when n equals to 5, and this is for at 6%, 4.212, and then deduct the annuity fraction when n equals to 1 from it. In a short while we'll be having a break as well. So n equals to 1 is 0.943. You have to deduct it from this one because we don't need the fraction from year 1. In year 1 there are no tax payments or savings. So the sum of both of these is 3.269. So now if you multiply the cash flow 380,000 with 3.673, you arrive at 3.269. And then the tax saving 114,000 multiplied by 3.269. So the net amount gets equal to 1023074. Okay. Yes, this is delayed annuity. The lease rentals, the lessor has the ownership of the license and the equipment, right? So as he has the ownership of the equipment, he will be paying the license fee and he will be taking some excessive rentals from you in order to recover the license fee. So as it is always already included in the license, sorry, in the rentals, you won't be paying it separately to the lessor. That's why we have not considered it over there. Okay. Yes, in 380,000, the license fee is included. You're right. No, in first option we are borrowing funds. In the second option, leasing option, we are not borrowing funds, but the cost of capital, the borrowing cost will remain same, so that we keep them like versus like. Usually the cost will be same in both cases. You will be using the borrowing rate in both cases, which is 6% net of tax. Yes, the license fee is written that 104,000 is payable by the end of the year 1. No, it's not like that. It's payable at the end of the year 1. Year 1 means 12 months. By the end of year 2, if they would have said, then we would have taken at 24 months on the second year. Is it okay, Omar? Okay. So students, Let's have a 5-minute break, a shorter break today. We have to do a lot. We have to start working capital as well today. So, acha, you have a small assignment for tomorrow, and that assignment is you have to do the part B of this question. You have to calculate net present value, the simple net present value which we calculate with inflation and all. So the part B is to be done by you people because it is just a present value calculation. So let me highlight it. So this part B and C, part B is present value, and EAC, which we did in the first question. These two parts are to be done by you as assignment for tomorrow, like you did Crockett today. Okay, students. So let's have a 8 to 10-minute break, and then we'll continue again. So see you after break. Welcome back, participants. I hope you would have had a nice break. You have said some prayers and had some refreshments. Okay, so let's continue now. Our next question is Munet company, question number 8. Let's put in some time, around 10 to 15 minutes on this, and then move on to the working capital management. One of the question has been asked that do we need to comment anything for lease or buy decisions? Yes, you may have to comment on the relevant cash flows to be considered in lease or buy decision. As I said, only differential cash flows will be considered. Secondly, you may have to comment on what is an operating lease and what is a financing lease. So you may have to comment on it. In case of operating lease, the substantial risk and reward remain with the lessor, and in case of finance lease, the substantial risk and reward remain with go to the lessee. It moves on to the lessee. So please go through the operating and the finance lease portion from the book, right, for this thing. Okay. Yes, you will get answers to the handouts. Don't worry, Vivek. Okay. Yes, you will get these questions and the answers together with them on the right hand side, the same Excel sheet on which you will get obviously you will find both the questions and the answers, right? So it will help you out side by side to read the questions and answers, right? Okay, so let's move on to the Munet PLC question. Now, again, students, uh, when studying investment appraisal, do study about the sensitivity analysis and the expected values, because examiner is also very fond of questioning uh, this risk and uncertainty portion of the investment decisions now on. So you can be asked a question on risk and uncertainty as well. So please go through this question. Munet PLC. I'll be doing part B and C of it. Part A is the payback period, which is simple. It's short working, so I'll be doing part A also, but I'll be giving more time on part B and C. Please read the question, which is above part A. Okay, for sensitivity analysis and for payback period, first of all, I will have to calculate the NPV. I will explain you what is sensitivity analysis, but first let me calculate the net present value of this proposal which they have given over here. So over here, the sales price is $3 multiplied by the quantity, which is 20,000 units, right? So the sales will occur for 5 years from year 1 till 5, right? And the cash flows will be 3 multiplied by 20,000 units. This means 60,000. Then the variable cost per unit is 1.65 multiplied by the production and sales, which is 20,000 units. So this will also occur for 5 years from year 1 till 5. And the cash flow amount will be 1.65 multiplied by 20,000. So this gives you a contribution 60,000 minus 33,000, and the contribution amount is 27,000. Rosemary, can you hear me right now? Can you hear me? Okay. Okay. There was a question regarding the lease or buy decision, that why didn't we consider interest? Interest is already considered when we calculate present value. When we calculate present value, the present values are lower than the actual cash flows. So already the interest gets removed from there. But we have not considered operating cost because it has been, operating cost will remain same whether we lease or whether we buy. So we will only consider those cash flows which are different in both evaluations. Differential cash flows are only used. That's why. Okay. And as I said that okay, so let's move onward. Now the fixed costs per annum are 10,000. So we'll deduct 10,000 from there. And now the initial investment amount is 50,000. So now the cash flows will occur from year 1 till 5, and the discount rate given in the question is 12%. So at 12%, look into the present value table. The present value table will show you the fraction for 5 years. When n equals to 5 years, the annuity fraction is 3.605. So pick that fraction, and then this will remain 3.605 for sales, variable cost, and fixed cost and contribution, because all of these items will occur for 5 years, for year 1, 2, 3, 4, and 5. So we have to calculate the present values 5 times equal cash flows. So we'll get the present values by multiplying the sales into 3.605, and then variable cost into 3.605. Likewise, we calculate these amounts. So the net amount after deducting fixed cost is 61,285. This is the present value of operating cash flows. All the operating expenses have been deducted from the sales, and then we deduct the present value of 50,000 will remain 50,000 only, right? Because it is payable immediately at the time of making the decision. So when we deduct the initial investment from the 61,285, we get the net present value. So I've used the NUT method over here because the cash flows were to occur every year for 5 years and were of equal amount. So the net present value is calculated to be 61,285 minus 50,000, and this makes 11,285. Okay, students, let me remind you one thing, that before the break we were doing that lease or buy question, and I want to make a conclusion over there before I move ahead, that which option was cheaper. If we buy the asset, in that case NPV of buying was 974,763, but in case of leasing the NPV was and both the NPVs are negative. So NPV of buying was 974,763 and the NPV of leasing was 1023,074. Therefore, the company shall buy the asset as the buying option involves a lower negative NPV, right? So this was the conclusion. Please write this conclusion down. I'm really sorry for missing it, because due to the break time started, I ended over there. Okay, so breaks are very important sometimes. Okay, okay students, let's move on to Munat PLC. This was our NPV working for Munat PLC. Let me shade it for clarity to you people. I'm shading it with yellow. So the NPV we have arrived at is 11,285. Now, how is sensitivity calculated and what it is? Let me explain it to you. See, what do we mean by sensitivity? In this case, the question is of risk. The risk is that any of the variables like sales price, it falls down. We have taken the sales price as $3. So if the sales price moves down and it behaves differently from our estimate, which is $3, what happens? If the sale price goes down, the sales amount, which I'll be showing you in red over here, 216,300, and the 60,000 annual sales, these will fall down. Suppose, for instance, the sales falls down to that amount, which gives you a present value of 2 lakh. What happens? Due to the fall in the present value of sales and the sales price, the NPV will go down. And if the NPV falls down more than 11,285, due to this, the NPV will get 0. And any excessive decline in selling price that makes the NPV fall more than 11,285 will make the NPV negative. So we can accept a sale price decline, but not more than that which reduces the NPV by more than 11,285. So this is the sensitivity. So the way there are variables like sales price, variable cost, fixed cost, quantities of the products and the sales of it. So if there is a change from our accounting estimates on the basis of which we are calculating the NPV. And those changes are very practical, that they can occur in the future, because these are all accounting estimates and the actuals can be different in reality. So we are predicting that what percentage of change can make the NPV zero or negative. So the smaller the change, the more sensitive it is, because chances of small changes is more, chances of larger changes is low, right? So we will see that which variable, if change by a very low amount, even then it makes NPV zero, then that variable will be more sensitive. So like this we evaluate. So sensitivity analysis means that a percentage change in a variable that makes the NPV zero. This is sensitivity. Now the formula is very simple. The sensitivity which is needed in this question is for sales volume, for sales price, and the variable cost, right? These three sensitivities are to be calculated. Now look at the formula. How do I make it? Percentage change in sales volume that will make NPV zero. Then percentage change in sale price that will make NPV zero. Then the third formula will be, the third requirement is percentage change in variable cost that will make NPV zero. Like these are the three requirements. Now on the basis of these requirements, I'll be making the formula. See, what is the formula for sales volume? See, due to the change in sales volume, two things will change. Two variables will be affected. What two variables? If the sales change, this 20,000 will change, and this 20,000 will also change. So this will impact this figure, ultimately this figure, the sales and variable cost. So ultimately, if anything which affects sales and variable cost affects what? The contribution. So due to decline, we are not afraid of rises in sales volume. An increase in sales volume would be good. A decline will be dangerous. A decline will decrease this contribution. Ultimately, due to this decrease in contribution, our NPV will fall, right? So we are afraid of this. So we'll talk about this. So what should be the formula? The formula is as follows. You will take NPV, because we are afraid that NPV shall not fall by 11,285, and we will divide with present value of contribution. So the tip is always calculate present values of those items which are going to be affected by the change in variables. Like due to sales volume change, the quantity of sales, the sales will also change and the variable cost will also change. So contribution will change. So I have purposely calculated the present value of contribution over there, 97,335. So what I will do, 11,285 is the NPV. Divide this by 97,335 and multiply it by 100. There you get the percentage. So the percentage is approximately 12%. So a 12% change or 11.59% change, a decrease in sale price, sorry, a decrease in sales volume of 11 volume will make the NPV 0. So 12% change is a big change. Usually usually around 5 to 10% change are practical. So this is not that sensitive, but obviously we have to investigate. A 12% change can also occur. It depends on the economic conditions of a country and the industry in which the business occurs. And so what should be the next formula? Now what happens that if you move on to the sales price, the change in sale price in our question will only affect the sales only, and ultimately the present value of sales. So the NPV shall be divided by present value of sales only. So this will be the formula multiplied by 100. So there is a multiplied by 100 in all cases. Then NPV divided by present value of sales. And then over here, the answer will be 11,285. This much of change is acceptable. We can afford to lose only 11,285, not more than that. Otherwise, we will get a negative NPV. And what is the present value of sales, which is 216,300 multiplied by 100. So this gives a very small change. So this is more sensitive to sales volume. Only a 5.82% change. So 6% change is smaller change. So this is more sensitive. The sales, even a very small change is bringing the NPV down to 0. So again, there is a decrease. A decrease in sales price up to 5.82% is acceptable. Not more than that. And you can calculate that amount as well. You can take 5.82% of $3 and deduct it from $3. So you will get the sales price. So you can calculate the price also by deducting 5.82% of $3 in order to arrive at the lowest price, which is acceptable. Then in case of variable cost, the formula will be NPV divided by present value of variable cost. Multiplied by 100. So 11,285 divided by the present value of variable cost, which is 118,965. So a 9% change, which is bigger than the sales price but lower than the sales volume. So the most sensitive item over here is the sales price. The smallest change that can bring NPV down is sales price. So remember, we were talking about simulation earlier. So in case of simulation, we can consider all these three variables together. But in sensitivity, we are talking about these three variables separately. So that's the problem over here, that in practical situation, not only one variable will change, all will change together. So simulation is a better technique compared to the sensitivity analysis. In case of variable cost, an increase in variable cost can reduce the NPV. Okay, and in the last case, we need to calculate the expected present value. So let me calculate the expected present value in the last part. Please go through part C. Please read down the part C so that I can calculate the expected value. You remember expected value is outcome multiplied by the probability and sum of all. Payback period is in how much time the initial investment amount will recover. Let me tell you how it will be calculated. Payback period will be calculated as follows. But you have to go through it. If you don't know, please go through the book and the kits regarding these questions, because you can get a bit advanced question on payback period than this one. This is a simple one, but let me tell you at least a basic of it. Payback period tells you that in how much time you will receive your initial investment back. So the initial investment in this case was how much? 50,000. And every year you are getting how much? You're getting this much amount. 27,000 is the contribution. Deduct 10,000 fixed cost from it. So you get 17,000 every year from this project. So if you are getting 17,000 every year and you need to have 50,000, which is your initial investment. So in how many years you will get the money returned? So it is 50,000 divided by 17,000 every year you are getting. So around 3 years. So in 3 years time, $2.94 you will be paid back. In less than 3 years, your 50,000 are returned. Is it okay, Mohammed Ashik? This is the payback period. You can convert it in months as well. So 2 years, and in case of months, 0.94 multiplied by 12, multiply 0.94 into 12 months. So you can get in months. So around 12 months, 11 months, 2 years and 11 months, you can get it back. So this is the payback period. Okay. So let's move on to the expected value calculation. So what they say, that there are 3 situations: poor, normal, and good. 3 possibilities. So when there are various possibilities, you can calculate an expected value. So the sales units in poor condition are 17,500. In normal condition, it is 20,000. In case of good condition, 22,500, right? And the sales price is 3 in all cases. So let's take contribution per unit over here. So contribution per unit is 1.35. 3 minus 1. The variable cost per unit was 1.65. So 3 minus 1.65 gives you a contribution of 1.35. And then if you multiply the sales unit with contribution per unit, you get the contribution. So 17,500 into the contribution per unit this gives you the contribution per annum, and then if we deduct the fixed cost from it, which is 10,000 each year, in 3 situations, then you get the net operating cash flow. So 23,625 minus 10,000, 27,000 minus 10,000, and then 30,375 minus 10,000. So this will be your net operating cash flow per annum. Now, if you multiply this with your annuity fraction at 12%, you will get the present value, and then you will deduct the you cannot ensure the sensitivity. You just need to put a research on, so that you can come to know that this much of change will not occur. But if a big change can occur and your sensitivity is low, then you should not start that project. Right, Mohammed Shayan, is it clear? So if the sensitivity is high, you should ensure that this much change is not going to occur. So you have to put in some research, and you have to find out that this much change would not occur. Otherwise, the project will be a loss-making project, right? Okay. So 3.605 was the annuity fraction. So we'll multiply that this cash flow by 3.605 in all these 3 situations to arrive at the present value of operating cash flow. So this will be this, you get the 5 years present value, and from this you will deduct the initial investment. So the initial investment is 50,000. So in all the cases, I have deducted 50,000, which is the initial investment. Only the sales volume was changing. So I have calculated I'm calculating 3 NPVs at 17,500 level, at 20,000 level, and at the 22,500, the good level. Now see, at the poor level, the NPV is negative. So this can happen in uncertainty condition in future. It may occur that we have assessed that normal condition will occur, but in actual a poor condition occurs. So the NP will get negative in that case. So we should consider this in advance. Okay, so that's the NPVs. There we get the NPVs. And now we will multiply the NPV with the probability. So NPV multiplied by probability, and sum of all will be the sum of all NPVs into probability will give you the expected value. So the probability of poor conditions is 0.3. The probability of normal condition is 0.6, and the probability of good condition is just 0.1, which is 10%. So I'm multiplying these items, which are in red, fonts in red, to arrive at NPV into probability. So you are getting the figures in green. You will get the figures in green. You have to add the figures in green. Please add the figures appearing in green to arrive at the expected value, expected NPV. So if you have various possibilities, first calculate NPVs at various possibilities. And then after you calculate the NPVs which are in red, then multiply it with the probabilities, which is also in red, 0.3, 0.6, and 0.1. And then you arrive at the green figures. And then you add all the NPVs into probabilities to arrive at the expected NPV, which is in yellow. So that's the expected NPV calculation 8851. So students, that's all about the investment appraisal. Now we move on to the working capital handout, and we will start working on working capital. Please complete this. I'm giving you 2 minutes. Then I'll talk about working capital management a little bit today, and then tomorrow we'll be working on it in detail, and then financing decisions as well. Yes, if you first multiply your probabilities with the cash flows, right, and then you multiply with the annuity fraction, you will get the same answer. The reason behind is that the annuity fraction is same. The rates are not changing. The annuity fraction is 3.605. It's same for every year. So it's okay. One of the questions is that why didn't I calculate expected sales first? So you can calculate expected sales also first. It doesn't matter. You will get the same answer. So Lydia, if you calculate the expected sales first and then calculate the contribution and present value, you will get the same answer. Doesn't matter. So I hope Lydia, Idrissa, you would have got it. Yes, question 6 will be discussed, but when I get a bit of time, I will discuss it at that time. Don't worry. I will discuss the answer with you. Yes, I'll send this Excel file. Okay, students, let's move on to the working capital management now, as we are running out of time. So I'm moving on to the next file, our working capital management file. Okay, so before going on to the question, let me briefly discuss the working capital management's basics first. Actually, I'm covering the both portions. I'm covering the calculations and the theory part as well, both. There are places where students face problem. I have judged those portions in advance, and the places where I need to explain, I'm also explaining them, and I have kept a balance between both of the portions, the calculation portion and the theoretical portions. So it is working according to a plan. So I hope you people are enjoying working on these questions and listening to me. So let's move ahead. Obviously, 100% of the coverage of the syllabus is not possible in these 15 hours. So I'm trying to cover the majority portion using which you can improve your strengths, right, and reduce your weaknesses. Like in sensitivity analysis and all, I explained you about things. Okay. Thank you, Ahmed and Ashik. Okay. So let me move on to the working capital management basics. See, yes, I'll tell you this theory writing tricks as well. Like remember, I told you some tricks in when writing the limitations. So I will tell you some more tricks in working capital management as well, because you get some theory in working capital. There are 3 areas where you will be getting theory writing questions. One is investment appraisal, second is working capital management, and third is financing decision. So tomorrow we'll be doing working capital and most probably financing decision as well. So the the writing tips continue tomorrow as well after this today's work, right? So you will be getting some more tips as well. Okay. So now let me continue on working capital management. So Students, see what is working capital. Working capital is basically investment by a business in current assets, like in stock, in receivables. So you need to put some cash into the working capital. Uh, See, the business generates cash and obtains finance. Remember that you have learned an equation: asset equals to liability plus capital, or liability plus equity in past. So what do this equation mean? That the business brings in cash from liabilities and capital, from either creditors or banks or from the owners. From these people it brings in cash, and then they buy assets. So none of the assets can be purchased without obtaining funds in the business. So business is a separate entity in which we have to first put in funds. Now remember, each and every dollar have a cost. It may have an opportunity cost or a cash cost, right? So if you bring in some dollars as a loan, so you have to pay interest on it. If you bring in overdraft, you have to pay interest on it. If you bring in overdraft and buy inventory, you have to pay an interest. So there is a cost of obtaining finance. And if you buy current assets from it and your current assets are increasing, so you are needing more and more and more finance, and you are incurring more and more cost, be it opportunity cost or be it an interest cost. So there is a cost of obtaining more and more current assets. So as a business starts, it cannot work without cash. You need to pay to your you need to pay your wages, you need to pay maintenance expense of machineries, you need to buy inventories, you need to, yeah, like you need to buy raw material, you need to buy finished goods, you need to pay your labor, you need to pay your electricity bills, you need to pay the gas bills, the power bills. So there are various expenses you need to meet, for which you need cash. And apart from this, you need to buy the non-current assets. So we are not talking about non-current assets over here in working capital management. So some funds go to the long-term assets, like machineries, factory, buildings, which build your capacities, which provide you capacity to work on. But those capacities cannot be used. If you have a showroom and you don't have inventory, it's useless. Showroom is a non-current asset. You can't sell anything without inventories. So you have to invest some funds in inventory. And again, if you buy inventories, some of the funds go into inventories and you bear an interest cost. There is a cost of maintaining inventories. So this inventory, receivable, and cash, which has been invested in a which are required to run those capacities, need financing cost. Now, this was one aspect, the cost aspect. If you hold a lot of current assets, lot of funds get tied up into it, a huge cost and less profits. So your profits go down. So you should not have unnecessary working capital and current assets. Otherwise, you are bearing a big cost and your profits go down. Secondly, the second aspect of working capital is liquidity. That if you don't have working capital, what happens? Or you have less working capital than required, what happens then? So in that case, what happens? That you won't be having sufficient cash to pay your creditors. Like suppose you don't invest in cash and you don't have inventories and you don't have receivables. So how will you get cash? The receivables will get converted someday into cash, or you will be having some deposit accounts and having cash in your deposit accounts, which will be available to pay off your electricity bills, which will be available to be paid to your labor. If you don't pay them on time, they won't work for you, they won't give you services. So you will be facing a liquidity problem and you won't be able to run the business. So at one place there is a profitability and cost problem. So you should not have excessive working capital, and you should not have excessively low working capital. You should not have any shortage of working capital or current assets, because you won't be able to make your payments for services and goods. If you won't be able to pay your services and goods, you won't be able to run your business. So at both ends, you have to maintain a balance. You have to maintain the profits as well, and you have to maintain the liquidity as well. So you have to have a reasonable amount of working capital. Now, our first question on working capital over here is based on cash budgets. Now, cash budget is a technique through which we come to know that how much cash we will need in the future, and we can make arrangements in advance. Like if we have a lot of payments in future and we are not going to make that much of receipts, we can go to banks and arrange some overdraft limits, some more overdraft limits, so that we can obtain overdraft financing from the banks, and therefore we can easily meet our cash payments. So obviously it will involve cost, but if we don't have any overdraft amounts and we know that in future we are having a lot of payments, how will we be able to pay? So cash budgets gives us an indication in advance that we are going to face a problem in future, and we can make efforts in advance to arrange for it. Secondly, the cash budget also help us in finding out that whether we'll be having some surpluses of cash in future. If we already know in advance that there are going to be some surpluses in future, we can plan to invest those surpluses in good places, so that until and unless they are required in the short term, and until they are required in future, we can place them into a good investment and earn some good returns from it, like investing them into some deposit accounts. So until we need it back when we enter a season, a good busy season, and we need cash, so we can uh, get a return from that investment, and for 2 to 3 months or 5 months time, until they are deposited over there, we can earn a return from there. So this is what how the budgets help us. So we will prepare a cash budget in our first requirement, the fleet company. So please go through this question. Fleet company, question number 1, we will be doing requirement A: calculate the cash balance at the end of each month in the 3-month period. So please read this question out. I'll be solving it in a few minutes time. So you may be required to make a cash budget in requirement C, in the section C, sorry. I'm making the pro forma until you are reading the question. So keep a calculator also in your hand, so that you can keep on working together with me, and we can do it fast at a faster rate. Okay, students, let's start with making the budget. So sales units are very clear. 1200 units will be sold in December, and the price per unit is 800. So this gives you a sales amount in dollars in thousands. I am taking the sales amount, which is 960,000. Then in January, 1250 units will be sold at 800, and the sales amount will be 1250 into 800. This will become 1 million in dollars in thousands, right? This is 1000 in dollars in thousands. So February, the sales units are 1300. Multiply this by 800. 1300 into 800 will give you 1,092,000. Then in March, 1400 units will be sold at 840. Okay, in February also the selling price is 840. So 1300 into 840, please use your calculator, students. In March, 1400 into 840, this will give you 1176. Okay, and then April, 1500 multiplied by 840. 1260 will be the sales amount. Yes, Idrissa, in February, March, and April, I have increased it by 5%. So it is now 840. Okay. Now, production. So according to the question, it says, please note this point. This is very important over here. This was to be noted. It says that production of goods, note number 2, for sale takes place 1 month before the sales. This means that the 1250 units of January will be produced in December. 1300 units of February will be produced in January. So 1 month in advance they are producing, right? You can, Arsalan, Heather, you can do the working in your cell. The examiner is bound to check your cell. So if you directly do the sales also and multiply 1200 into 800 in the cell, and you get 960,000 in the cell, the examiner will be checking it. So he will award marks over there. So don't worry. So you can do it like this also. I had to show basically these things to you. That's why I was making like this. You can do it directly in the cell. It doesn't matter. Okay. So now production 1250, 1300, 1400, and in March it will be 1500. The raw material cost is $200. Dollar 2 units are required. 2 units of raw material required per production unit. So first I will be multiplying 1250 into 2. So this gives me 2500 units of material will be required. So this is at 2 per unit. Then 1300 into 2 gives me 2600. Then 1400 into 2 gives me 2800. And then 1500 into 2 gives me 3000. After that, raw material cost. So students, the raw material cost of material is $200. So now multiply 2500 with 200. This gives you 500,000, and I am taking it in thousands. So it will make 500,000. 500 will become 500,000. Then 520,000 in January. In February, 2800 into 200 makes 560,000, and in March, 3000 into 200 makes 600,000. So this is the cost of production. Okay. Then conversion cost. Conversion cost is raw material cost was 200 per material unit, and conversion overhead, variable overhead and wages, these are known as conversion cost, is 100 per unit. So multiply 1250 into 100 to arrive at the conversion cost. So this gives you 125,000, then 130,000, then 140,000, and then 150,000. Okay. So now we are in position to make the budget. We have made the basic workings. And now I'm making the budget. So first of all, collection from customers. So what do the questions say about collection from customers? The question says that sales are all on 1 month credit, means the sales of 960,000 in December is on credit. So you won't be receiving 960,000 in December. When will you receive it? You will receive it in January. So 960 will be received in January, and the January amount will be received in February, and the February amount will be received in March, right? So this is how the sales will be collected. Then what they say that the raw material, what they say about the raw material. About raw material, they say, okay, raw material purchase are on 1 month credit, means that if they have purchased raw material for 500,000 in December, so as they have purchased raw material in December, when will this be paid? This will be paid in January, and this 520,000 amount will be paid in February, and then 560,000 will be paid 1 month ahead in March. Okay, so it is important that you note properly that when the payment occurs. So in the first step, I calculated all the cost in December, January, February, March, and April, all the possible items, and then I have to find out that when will the payment or the receipt will occur. So the receipt and payments both are on 1 month credit, so they are occurring 1 month ahead. But the conversion cost, as per question, they say paid in the month of production. So conversion cost is paid in the month of production. So the January's conversion cost will be paid in January only, right? Then, okay, first let me put in the sales and material cost. Then we will move on to the conversion cost item. So conversion cost is simpler. In the same month it occurs, so we won't have much problem. Students, I will take 5 or 10 more minutes just to complete this cash budget, and then we will do the remaining work tomorrow. So I hope you can be with me for an extra 5 to 10 minutes at least, right? So thank you very much, students, if you remain with me. If you have any emergencies, you can continue. I won't mind. Okay. So let me put in the collection figures first. So collection in January, 960. In February, 1000. In March, 1092. And then raw material payments will be 500, 520, and 560. Then conversion cost payments. Conversion cost payments will be 130. Conversion cost payments will occur in the same month. January's conversion cost is 130, then February, and then March. So it's 130, 140, and 150. Then they say they have purchased a machine, note number 7, for 400,000 on cash in March. So there will be a outflow of 400,000 in March. So there will be two portions in cash budget, the receipt portion and the payment portion first, and in which will be put the receipts and payments. No, the conversion costs are not being paid earlier. They are paid in the same month of production. So the cost payments are connected to production, right? So production that occurred in January. So we would have paid the conversion cost in January only, right? But the production is being undertaken for February, 1 month earlier, right? With respect to sales, Omar, you are right. But with respect to production, it is in the same month. Okay. Let's move ahead. So the next is they raised a loan, note number 6. At the beginning of March, they raised a loan. So by raising a loan, they will receive a cash of 300,000. So this was all the cash flows that occurred. Now we will take a total of these items so that we get the net cash flow. For all the 3 months. Students, tomorrow's class will be very important. So in that class, I'll be discussing the changes in working capital policies, especially, which are very important and which are being asked very frequently now on in the exams. And usually student sometimes ignore these things, the changes in working capital policies and the effect of it on the profits and the decision making. So please be with us so that you can learn some important areas. So the opening balance, note 5, was 40,000 in January. So 40 was the opening balance. So 330 was the cash collected during the month of January. Then 40 was the opening balance. This makes 370,000. And this 370,000 will become the opening balance for the month of February, right? So we will take this 370,000 to the February's opening balance. This gives you 710,000 at the end of the February, and then this 710,000 at the end of February becomes opening balance for March, and then the March ending balance will become 992. Okay, so students, if you have any questions, you can ask now regarding this. The next remaining we will start inshallah in the next session tomorrow. So tomorrow we'll be doing some working capital work, and then we will moving on to the financing decisions as well. Yes, I'll be sharing in the worksheets with you people. Sure. In non-current assets costs, depreciation will never be shown in the cash budget because it will not result in a cash flow. Depreciation do not result in cash flow, so we'll never show it over here in the cash budgets. Secondly, the disposable value will come because it will result in a resale value. It will be shown in the collection portion, right? Okay, conversion cost, how did I get it? Conversion cost was the number of production units multiplied by 100. The conversion cost is 100. Conversion cost is wages and variable overheads, labor plus variable overheads. And I multiplied this with the production units with this. So multiplying by this, you get 130,000, right? Okay. So yes, I have taken the opening balance over here, 40, the opening balance of cash, and then added 330 to it. So I arrived at 370. Then this 370 becomes the opening balance for the next month, and 710 becomes the opening balance for the next month. So the opening balance has been added to the net cash flow, the cash receipts net during the year. Variable overhead cost, yes. Right, Abe? Notes are available in the control panel. You can download it from there, and you will get the group link. Day 3 we are doing financing and cost of capital. Tomorrow we'll be doing a bit of working capital and financing and cost of capital as well. So in the end, what happens that the day 4 and day 5 work involves only case section A and B type work. Section C type questions are not paged in it, so it will be covered more faster than these questions. The section C, actually we are doing the section C questions in the beginning, working capital, financing and investment appraisal. So this is it takes longer to do these type of questions. So in the end it will be doing faster because we don't get section C questions in the day 4 and day 5 work. So it won't be a matter over there, it will go faster over there. Okay. So thank you very much students for attending the day number 2 of financial management session. See you tomorrow with working capital and financing decisions. Goodbye. Thank you. Welcome. My pleasure. My pleasure. My pleasure to all, and welcome. Thanks a lot, Lloyd, for the compliment. Welcome, Vivek. Thanks for attending. Thanks to you all.